Listen carefully, because what I am about to explain can completely reapproach investing, decision-making, and I built success by recognizing value early, staying patient during chaos, and having the discipline to invest decisively. Today, I want to share the 2 stocks I would buy without hesitation if I were deploying fresh capital right now. Not later, not eventually, but immediately. Before explaining those choices, I want something from you, because serious investing requires commitment, focus, and a willingness to learn beyond surface-level market noise. If you genuinely want to build wealth, understand real investing principles, and think strategically instead of emotionally, you should subscribe to this channel right now. This is about real businesses, real strategies, disciplined thinking, and decisions that compound over years rather than days or weeks. I want to know you are serious, because disciplined investing is a long journey, and the mindset you bring matters just as much as the stocks you buy. Now, let me frame the environment we are operating in, because context always matters when evaluating opportunities and understanding risk intelligently. We are living through one of the most complex economic periods I have seen, with inflation fears, interest rate uncertainty, and most investors are panicking, reacting emotionally, and freezing because uncertainty makes people uncomfortable and pushes them toward bad short-term decisions. When everyone else hesitates, disciplined investors step forward because fear creates mispricing and separates thoughtful strategy from emotional reaction. Too many people misunderstand investing entirely, treating it like gambling, guessing, or hoping luck will somehow carry them to financial freedom. Real investing has nothing to do with luck, because it is about evaluating value, cash flow, execution, and durability across economic cycles. Successful investors focus on companies that generate real cash, defend their market position, and are led by teams that allocate capital intelligently. Most importantly, they buy those companies when enthusiasm is low, not when headlines are glowing and valuations are already inflated. After evaluating thousands of businesses throughout my career, I know exactly what separates durable winners from fragile companies that eventually disappoint investors. The 2 stocks I am discussing today share the characteristics I consistently look for, including cash generation. These are not speculative bets, unproven startups, or hype-driven stories built on promises rather than profits and operational reality. They are established businesses producing real earnings, returning capital to shareholders, and operating in industries essential to modern economic function. Let me ask you something important, because honesty matters when discussing money and long-term financial outcomes. When was the last time you studied a balance sheet, evaluated cash flow consistency, or considered how dividends compound over long periods? Most people never do, choosing instead to follow television personalities or anonymous online commentators who rarely manage real capital responsibly. That approach is not investing, it is noise, and today my goal is to remove that noise and replace it with disciplined clarity. I approach every investment as if advising my own family, because time and capital are valuable and should never be wasted on weak ideas. Every dollar I invest must work efficiently, generate returns, and justify its place, or I replace it with a better opportunity. A core part of my philosophy centers on cash flow and dividends, because getting paid while you wait creates stability and long-term confidence. Dividends are real, accountable, and impossible to fake, because a company must generate actual cash to distribute it consistently. In volatile markets, dividends provide protection, income, and the ability to reinvest during downturns when valuations become attractive again. When markets inevitably decline, dividend income continues, allowing disciplined investors to accumulate more shares at discounted prices. That reinvestment process fuels compounding, which remains one of the most powerful and underestimated forces in long-term wealth creation. Quick profits attract attention, but disciplined returns build wealth steadily, predictably, and with far less emotional stress over time. I look for companies with pricing power, because inflation punishes businesses unable to pass costs forward without losing customers. Competitive advantages matter deeply, whether through scale, infrastructure, brand strength, or regulatory barriers that protect long-term profitability. Finally, valuation always matters, because even exceptional companies can become terrible investments when purchased at irrational prices. These principles have guided my decisions for decades and continue shaping how I evaluate opportunities, regardless of market conditions. The stocks I am sharing are long-term holdings, not trading vehicles, because real wealth is built by owning quality businesses patiently. Over multiple market cycles, owning durable companies through volatility consistently outperforms emotional trading and short-term speculation. Now let me introduce the first stock, which many overlook because it is not flashy, trendy, or exciting in conversation. This company operates within energy infrastructure, owning critical pipelines, storage, and terminals that move essential resources across North America. Its revenue is based on volume, not commodity prices, making it more stable and predictable than most people realize. Think of it as a toll road for energy, collecting fees regardless of political debate, market sentiment, or daily price fluctuations. Energy must move, homes must be heated, factories must operate, and transportation must function regardless of headlines or economic cycles. Building competing infrastructure is nearly impossible due to regulation, giving this company a powerful and durable competitive moat. Its long-term contracts provide predictable cash flow, enabling consistent dividend payments and thoughtful capital allocation decisions. The dividend yield exceeds 6%, supported by decades of payments, responsible debt management, and investment-grade credit ratings. Valuation remains attractive because attention has shifted elsewhere, creating opportunity for investors willing to buy quality while it is ignored. I buy, hold, reinvest dividends, and allow time to work. Because patience comes with cash flow, this infrastructure will remain relevant for decades, adapting alongside energy evolution rather than disappearing from the economic system. That combination of stability, income, and undervaluation makes this first stock an easy decision for disciplined, long-term investors. A strong portfolio is never built around a single idea, because concentration without balance exposes investors to unnecessary. Now that we have covered the first stock, which focuses on stability, income, and durable infrastructure, let us move forward and complete the picture. The second stock I would buy without hesitation complements the first perfectly because it adds growth potential while maintaining quality, cash flow, and discipline. When I talk about healthcare investing, and I am focused on inevitability, scale, necessity, and long-term debt courses, this second opportunity sits within the healthcare sector, but not in the speculative corners that rely on uncertain trials. One of the most powerful trends shaping our economy is aging, because demographics move slowly but exert enormous influence over decades. Every single day, thousands of people reach retirement age, and that trend will continue regardless of economic cycles, politics, or market sentiment. As people age, healthcare usage rises consistently, creating durable demand for products, services, and systems that support modern medical care. This is not speculation, optimism, or storytelling. It is math, population data, and historical precedent playing out predictably over time. The company I am referring to operates in a critical niche, providing essential healthcare products used across hospitals, clinics, and treatment centers. Products are not optional, discretionary, or easily substituted because they form part of standardized medical procedures and patient care protocol. When a product is essential, pricing power increases because reliability, quality, and outcomes matter more than small differences in cost. Hospitals do not experiment with cheaper alternatives when patient safety and regulatory compliance are involved, creating significant switching costs. That stickiness creates a competitive moat that protects margins, stabilizes revenue, and supports long-term financial performance even during downturns. Healthcare spending remains resilient during recessions because people delay purchases of cars or homes, but not necessary medical treatment. This company generates substantial free cash flow, maintains a strong balance sheet, and deploys capital responsibly across dividends and share repurchases. The dividend yield is lower than the first stock, sitting near 3%, but it grows consistently and reflects embedded growth expectations. You are paid to wait, while the business compounds internally through reinvestment, innovation, and expanding demand from aging populations. What excites me most about this company is not a single product, but the ecosystem it has built through relationships and operational scale. Decades-long partnerships with healthcare providers establish trust, reliability, and integration that competitors struggle to replicate quickly. Scale allows better supplier negotiations, higher research investment, and operational efficiencies that smaller players simply cannot match. Efficiency matters deeply in healthcare because cost control directly translates into margin stability and sustainable profitability. The company also benefits from diversification across multiple product categories, reducing reliance on any single customer or revenue stream. The company also benefits from diversification across multiple product categories, reducing reliance on any single customer or revenue stream. If one segment faces temporary pressure, others continue performing, creating earning stability and predictable cash generation. That stability supports dividend consistency, share repurchases, and long-term confidence for investors seeking reliability alongside growth. Regarding valuation, this stock is not deeply discounted, but it is fairly priced relative to quality, durability, and future growth potential. I am comfortable paying a reasonable multiple for a great business because quality compounds far more effectively than cheap mediocrity. Overpaying slightly for excellence is far less dangerous than buying weak businesses simply because the price appears attractive. Cheap stocks are often cheap for valid reasons, including declining relevance, poor management, or eroding competitive positioning. This healthcare company is none of those things because it operates at scale, adapts continuously, and executes consistently. Management has demonstrated discipline through capital allocation, strategic investments, and a clear focus on long-term shareholder value. Looking forward 5 or 10 years, the growth drivers remain intact, supported by demographics, system integration, and recurring demand. That visibility allows me to sleep well at night owning this business, even during periods of market volatility or negative sentiment. Personally, I am building positions in both of these stocks because together they create balance across income, growth, and sector exposure. The energy infrastructure stock provides stability, yield, and inflation protection, while the healthcare stock delivers compounding growth potential. Together, they form a foundation capable of weathering economic cycles without relying on speculative trends or unrealistic expectations. Some investors ask why I am not focusing entirely on technology or artificial intelligence, given the excitement and headlines dominating markets. There will always be money made in technology, but when everyone crowds into the same trade, risk increases and returns often compress. High expectations leave little margin for error, and disappointment can lead to sharp corrections even for strong companies. I am not against technology, but I believe it should complement a portfolio, not replace its foundation entirely. Boring businesses that generate cash, pay dividends, and survive decades should form the core of any serious investment strategy. Once that foundation is established, calculated risks can be layered on thoughtfully without jeopardizing long-term financial security. Speculation without foundation leads to emotional decisions, panic selling, and ultimately starting over after avoidable losses. Too many people reverse this order, chasing excitement first and stability later, often learning expensive lessons along the way. What I am offering here is a blueprint, not a promise of quick wealth or instant gratification. These two stocks will not double overnight, but they will compound steadily if owned patiently and managed with discipline. They generate income, grow earnings, and provide resilience when markets become volatile or uncertain. I have lived through market crashes where portfolios declined sharply, yet confidence remained because the businesses owned were strong. Dividends continued, cash flow remained intact, and recovery followed for those who resisted emotional selling. That mindset is essential because investing success depends more on behavior than intelligence or prediction accuracy. You must remain calm, disciplined, and committed to your strategy even when it feels uncomfortable or unpopular. Owning businesses you understand deeply makes that discipline far easier to maintain during turbulent periods. The two stocks I have discussed meet that standard, combining clarity, durability, and shareholder-friendly execution. Now it is your responsibility to act thoughtfully, beginning with your own research and independent evaluation of these ideas. Review financial statements, read annual reports, and understand how each business generates revenue and defends its position. Education creates confidence, and confidence allows you to remain patient when markets test your resolve. If this approach resonates with you, subscribe to this channel and become part of a community focused on disciplined investing. We are not here for hype, shortcuts, or speculation, but for sustainable strategies that build wealth over time. Leave a comment and share your thoughts, your strategy, and the types of businesses you believe belong in a long-term portfolio. This is a conversation because learning improves when perspectives are shared openly and thoughtfully. Remember, markets do not care about emotions, urgency, or personal timelines, but disciplined investors can still succeed consistently. Position yourself correctly, focus on fundamentals, and let time work in your favor rather than against you. That is how I have approached investing for decades, and it remains my guiding principle today. Stop chasing noise. Start valuing substance and build a portfolio designed to support you for years to come. Energy infrastructure and healthcare are my two picks, not because they are exciting, but because they are reliable and enduring. They generate cash, adapt to change, and reward patience, which is exactly what long-term investors should demand. Thank you for staying through this discussion and committing time to improving your investment thinking.